Have you ever wondered why some traders make money consistently while others blow up their accounts studying every indicator known to mankind? Here's something that might shock you. The trader who barely knows what RSI stands for but follows three simple rules religiously will destroy the technical analysis wizard who can spot a descending triangle from Mars but can't stick to a plan for more than 5 minutes. Professional trading firms don't hire people based on their ability to identify chart patterns. They hire people who can follow instructions without deviation. Yet every trading course on the internet will try to convince you that success comes from mastering more indicators, learning more patterns, and analyzing more time frames. This obsession with technical complexity is exactly what separates winning traders from losing traders, and it's the opposite of what you think. Today, I'm going to reveal why behavioral discipline matters infinitely more than technical knowledge, why the simplest systems often produce the best results, and how traders with basic setups consistently outperform those with sophisticated analysis. We'll examine the psychology behind why complexity feels smart but destroys accounts, look at real data from professional firms, and I'll show you exactly what good behavior looks like in practice. But first, let me share something that completely changed my perspective on trading. I spent 2 years learning every technical indicator I could find: Fibonacci retracements, Elliott waves, harmonic patterns, volume profile analysis. My charts looked like Christmas trees with more lines than a subway map. I was convinced that more knowledge meant better results. I was dead wrong. The turning point came when I met a trader at a conference who had been profitable for 8 years straight. When I asked about his setup, he laughed and said he only used 2 moving averages and price action. 2 moving averages. That's it. No fancy indicators, no complex algorithms, no proprietary software. Just 2 lines on a chart and the discipline to follow his rules every single time. Here's what most traders refuse to accept. Technical analysis is not what makes you money. Behavior is what makes you money. Technical analysis is just the vehicle. You could have the most sophisticated Ferrari in the world, but if you can't drive properly, you'll crash it into a wall. Meanwhile, someone with a reliable Toyota who follows traffic rules will reach their destination safely every time. The trading education industry has this completely backwards. They sell complexity because complexity feels valuable. A course teaching you 17 different indicators sounds more impressive than a course teaching you to follow 3 simple rules. But impressive sounding education and profitable trading are not the same thing. Let's talk about what good behavior actually looks like in trading. First, it means having a predefined plan before you ever enter a position. Not a rough idea, not a general direction, but specific criteria for entry, exit, and position sizing written down in advance. Good behavior means following that plan regardless of what your emotions are screaming at you in the moment. Second, good behavior means accepting losses as a normal part of business. Poor traders treat every loss like a personal failure that needs to be avenged immediately. Good traders treat losses like operating expenses. They expect them, plan for them, and move on without emotional attachment. Third, good behavior means consistency in execution. This is where most traders fail spectacularly. They'll follow their system perfectly for 2 weeks, hit a small losing streak, and then abandon everything to chase the latest strategy they saw on social media. Good traders stick to their approach through winning streaks and losing streaks alike. The fascinating thing about behavioral discipline is that it's completely independent of technical knowledge. You don't need to understand why a moving average crossover works to profit from it consistently. You just need to follow the signal every single time it appears. The trader who executes a simple system with perfect discipline will outperform the trader who executes a complex system with mediocre discipline every single time. Think about professional sports for a moment. The fundamentals of basketball haven't changed in decades. Dribble, pass, shoot, defend. Yet teams spend millions of dollars not on teaching players new fundamentals, but on ensuring they execute the basic fundamentals flawlessly under pressure. Trading is exactly the same. The fundamentals of profitable trading are simple and haven't changed. The challenge is executing them consistently when your account is on the line. Here's where it gets really interesting. Research from behavioral finance shows that overconfidence in technical analysis actually makes traders perform worse, not better. The more indicators someone uses, the more likely they are to find conflicting signals that paralyze their decision-making or give them false confidence to overtrade. There's a study from the University of California that tracked retail traders for 5 years. The traders who used the most complex technical setups had the worst performance, not because their analysis was wrong, but because they couldn't execute consistently. They were constantly second-guessing themselves, adding new indicators when the old ones didn't work, and changing their approach based on recent results. Meanwhile, the most profitable traders in the study used incredibly simple approaches. Moving average crossovers, basic support and resistance, simple momentum indicators. Nothing fancy, nothing complex, nothing that would impress anyone at a trading conference. But they followed their simple rules with religious consistency, and that consistency compounded into substantial profits over time. Professional trading firms understand this completely. When Goldman Sachs or JP Morgan hire traders, they're not looking for people who can recite every chart pattern in existence. They're looking for people who can follow risk management protocols without deviation, who can stick to position sizing rules under pressure, and who won't let emotions drive their decisions. The dirty secret of institutional trading is that most profitable strategies are boring and simple. They work because they're executed with institutional discipline, not because they involve sophisticated analysis. A simple trend following system executed with perfect discipline by a team of traders will generate consistent profits. The same system executed by individual retail traders who modify it based on their feelings will lose money consistently. This brings us to a critical point that most traders never consider. Your behavior under stress reveals everything about your trading future. You can backtest a strategy for years and get perfect results, but if you can't execute that strategy when you're down 3 trades in a row, the backtest is meaningless. Good behavior isn't just about following rules when it's easy. It's about following rules when every instinct you have is telling you to break them. When you've lost 4 trades in a row and your system says, take the 5th trade, good behavior means taking that trade with the same position size and the same confidence as the first one. When you're up 5 trades in a row and feeling invincible, good behavior means not increasing your position size just because you're feeling lucky. When the market is moving against you and you want to move your stop loss to avoid taking a loss, good behavior means taking the loss according to your original plan. The market is constantly testing your behavioral discipline. Every winning streak tests whether you'll get overconfident and increase risk. Every losing streak tests whether you'll abandon your system or start revenge trading. Every unexpected market move tests whether you'll stick to your plan or panic and make emotional decisions. Here's what separates consistently profitable traders from everyone else. They've learned that their behavior is their edge, not their analysis. They understand that the market doesn't care how smart they are, or how many books they've read, or how sophisticated their charts look. The market only rewards consistent execution of a proven approach. A approach and proven consistent execution of. This is why most traders fail before they ever place their first trade. They spend months learning technical analysis and exactly 0 time learning to control their own behavior. They can tell you everything about stochastic oscillators, but can't tell you what they'll do when they're down 20% for the month. They know every Fibonacci level by heart, but have never practiced taking a loss without feeling like they need to immediately get back into the market. The most successful traders I know have incredibly boring routines. They check their charts at the same time every day. They risk the same percentage on every trade. They follow the exact same process for every decision. This isn't because they lack creativity or intelligence. It's because they understand that consistency creates compound returns, while creativity creates compound losses. Let me give you a real example of how this plays out. I know 2 traders who started with the same capital, learned from the same mentor, and traded the same basic strategy. Trader A decided the system was too simple and began adding multiple time frame analysis, volume indicators, and market sentiment filters. His charts became incredibly sophisticated. Trader B stuck to the original simple system, but focused entirely on execution discipline. After 2 years, Trader A had blown through 3 different strategy modifications and was barely breaking even. He could give you a dissertation on why each trade made sense technically, but his account told a different story. Trader B had tripled his account using the same boring system day after day. The difference wasn't intelligence or market knowledge, it was behavioral discipline. Here's what's really fascinating about good trading behavior. It's completely learnable, but most people refuse to learn it because it doesn't feel like real education. Reading about position sizing rules feels less valuable than learning about exotic chart patterns, even though position sizing will determine your long-term survival, while chart patterns are mostly irrelevant noise. Good behavior starts with accepting that trading is primarily a game of risk management, not market prediction. Poor traders focus on being right about market direction. Good traders focus on managing their risk when they're wrong. This fundamental shift in mindset changes everything about how you approach the markets. When you understand that your job isn't to predict the future, but to manage uncertainty, you stop looking for perfect setups and start looking for acceptable risk-reward scenarios. You stop trying to be right all the time and start trying to be profitable over time. This mental shift is worth more than every technical analysis book ever written. The best traders develop what I call systematic paranoia. They assume they're wrong about every trade until proven otherwise. They plan their exit before they plan their entry. They know exactly how much they're willing to lose before they calculate how much they might make. This isn't pessimism, it's professionalism. Think about how airline pilots approach their job. They don't focus on the 99% of flights that go perfectly. They spend most of their training time learning what to do when things go wrong. Emergency procedures, system failures, weather problems. The technical aspects of flying are important, but the behavioral protocols for handling emergencies are what keep passengers alive. Trading is exactly the same. The technical aspects matter, but the behavioral protocols for handling losses, managing risk, and maintaining emotional control are what keep your account alive. Yet most trading education focuses almost exclusively on the technical aspects while completely ignoring the behavioral requirements. Here's a simple test that reveals everything about your trading future. Write down your trading plan in detail, not just your entry criteria, but your exact position sizing rules, your stop loss placement, your profit-taking strategy, and what you'll do if you hit a losing streak. Be specific about everything. Now ask yourself this question. If you followed that plan exactly for the next 100 trades, would you be profitable? If the answer is yes, then you don't have a technical analysis problem. You have a behavioral discipline problem. If the answer is no, then you need to fix your plan before you worry about anything else. Most traders never honestly answer this question because they know the answer will reveal that their problem isn't knowledge, it's execution. They'd rather keep learning new strategies than face the uncomfortable truth that they already know enough to be profitable if they could just follow their own rules. The markets don't reward complexity, they reward consistency. The markets don't pay you for being smart, they pay you for being disciplined. The markets don't care about your analysis, they care about your execution. This is why good behavior outshines technical analysis every single time. Professional money managers understand this completely. They don't hire portfolio managers who can identify the most patterns or use the most indicators. They hire people who can stick to investment mandates without deviation, who can maintain risk controls under pressure, and who won't let emotions drive portfolio decisions. The technical analysis is often outsourced to research teams, but the behavioral discipline must come from the person making the decisions. Here's what really separates amateur traders from professionals. Amateurs think their edge comes from superior analysis. Professionals know their edge comes from superior execution of average analysis. An amateur will spend hours perfecting their entry signal and 30 seconds thinking about position sizing. A professional will spend 30 seconds on their entry signal and hours thinking about risk management. This explains why so many highly intelligent people fail at trading. Intelligence actually works against you in markets because intelligent people are used to being rewarded for finding complex solutions to difficult problems. But markets often reward simple solutions executed consistently over complex solutions executed sporadically. The paradox of trading education is that the more you learn about technical analysis, the worse your behavior often becomes. Knowledge creates confidence, and confidence creates larger position sizes, tighter stops, and more frequent trading. All of these behaviors decrease your probability of long-term success, even if your analysis improves. This is why many of the most successful traders I know deliberately limit their market information. They don't read financial news during trading hours. They don't follow dozens of market commentators on social media. They don't use complex analytical software. They've learned that more information leads to more opinions, and more opinions lead to worse decisions. Good trading behavior requires intellectual humility. You must accept that you don't know what the market will do next, that your analysis might be wrong, and that your edge comes from managing these uncertainties rather than eliminating them. This humility is what allows you to cut losses quickly, let winners run, and stick to your plan when every instinct tells you to deviate. The market is constantly trying to teach you that behavior matters more than analysis, but most traders refuse to learn the lesson. Every blown account teaches this lesson. Every successful trader embodies this lesson. Yet the vast majority of traders keep searching for better analysis rather than better behavior. Here's the brutal reality that nobody wants to acknowledge. Your technical analysis becomes completely worthless the moment your emotions take control. You can identify the perfect setup, calculate exact risk-reward ratios, and time your entry flawlessly. But if you can't handle the psychological pressure of watching your position move against you, none of that analysis matters. I've watched traders with PhDs in mathematics blow up accounts because they couldn't accept a small loss. Meanwhile, I've seen traders who barely finished high school become consistently profitable because they understood one simple truth. The market doesn't care about your education, your intelligence, or your analytical skills. The market only cares about your ability to execute your plan under pressure. Let me tell you about the most expensive trading lesson I ever learned. I had identified what I thought was a perfect trade setup. Multiple time frames aligned, volume confirmed the move, momentum indicators were screaming buy. Everything looked textbook perfect. I entered the position with confidence, knowing my analysis was spot on. Then the market did what markets do. It moved against me immediately. My perfect setup started falling apart within minutes of my entry. According to my plan, I should have cut the loss at my predetermined stop level, but my ego kicked in. I had done so much analysis. The setup was so perfect. The market had to turn around, so I held. Then I held some more. I watched a small, manageable loss turn into a significant hit to my account. I finally closed the position when the pain became unbearable, taking a loss 5 times larger than what my plan called for. My technical analysis had been wrong before, but my behavioral failure turned a minor setback into a major disaster. That single trade taught me more about trading than years of studying chart patterns ever did. It showed me that perfect analysis means nothing without perfect execution. It revealed that my biggest enemy wasn't market volatility or unpredictable price action. My biggest enemy was sitting in the chair looking back at me in the mirror. This is why successful trading firms spend more time training traders on psychology than they do on technical analysis. They understand that you can teach someone to read charts in a few weeks, but it takes years to develop the mental discipline required for consistent execution. They know that behavioral mistakes will destroy trading accounts long before analytical mistakes ever could. Think about what happens inside your head when you're in a losing trade. Your heart rate increases. Your palms start sweating. You begin questioning every aspect of your analysis. You check other indicators, looking for reasons to hold the position longer. You start calculating how much you need the next trade to win just to break even. This emotional cascade destroys your decision-making ability faster than any market move ever could. Good traders have learned to recognize these emotional responses and have systematic ways to deal with them. They don't try to eliminate emotions completely because that's impossible. Instead, they create behavioral guardrails that force them to make rational decisions even when their emotions are screaming at them to do something stupid. Here's something most traders never consider. Your worst trading decisions happen when you feel most confident about your analysis. Overconfidence breeds larger position sizes, wider stop losses, and longer holding periods for losing trades. The trader who thinks they've found the trade of the century is usually about to learn a very expensive lesson about market humility. Professional traders understand this paradox completely. The more certain they feel about a trade, the more conservative they become with position sizing. They've learned that certainty is often an illusion, and the market has infinite ways to prove you wrong, regardless of how perfect your setup appears. This brings us to something I call the complexity trap. As traders gain experience, they often make their systems more and more complicated. They add additional filters, multiple time frame confirmations, and exotic indicators. They convince themselves that more sophisticated analysis will lead to better results. But here's what actually happens. Complex systems create more opportunities for conflicting signals. When you have 15 different indicators, some will always be giving you reasons not to take the trade. This leads to analysis paralysis during good setups and false confidence during marginal setups. The trader becomes a slave to their indicators instead of using them as simple decision-making tools. I know a trader who started with a simple moving average system that was generating consistent profits. Over time, he added Bollinger Bands for volatility confirmation. Then he added RSI for momentum confirmation. Then MACD for trend confirmation. Then volume analysis for institutional activity confirmation. His system became so complex that he could always find a reason to avoid taking trades. His win rate actually improved because he was being more selective, but his overall profitability plummeted because he was taking far fewer trades and missing many profitable opportunities. He had optimized his system for being right instead of optimizing it for making money. These are not the same thing. The most profitable traders I know use embarrassingly simple systems. Moving average crossovers, basic support and resistance levels, simple momentum breakouts. Nothing that would impress anyone at a trading conference. But they execute these simple systems with machine-like consistency, and that consistency compounds into serious wealth over time. Here's why simple systems work better than complex ones. They're easier to execute under pressure. When the market is moving fast and your emotions are running high, you don't have time to analyze 17 different indicators. You need clear, unambiguous signals that tell you exactly what to do without interpretation or judgment calls. Simple systems also fail in obvious ways. When a moving average crossover stops working, you know immediately. When a complex multi-indicator system stops working, You might blame one component and keep trading a broken approach for months while your account slowly bleeds out. Behavioral discipline becomes infinitely easier when your system is simple enough to execute without thinking. The goal isn't to create the smartest possible trading approach. The goal is to create the most executable trading approach. These are completely different objectives that lead to completely different outcomes. Let me share something that will probably shock you. Most consistently profitable traders spend less than 10% of their time on market analysis. The rest of their time is spent on trade management, risk assessment, and behavioral review. They understand that finding good setups is the easy part. Managing those setups profitably is where the real skill lies. Poor traders spend 90% of their time trying to predict what the market will do and 10% thinking about what they'll do when their prediction is wrong. This backwards approach explains why so many analytically sophisticated traders struggle to make money consistently. The market doesn't reward you for predicting the future correctly. The market rewards you for managing uncertainty skillfully. This fundamental misunderstanding is why technical analysis obsessed traders often perform worse than traders who barely understand technical analysis but excel at risk management and trade execution. Here's a simple experiment that will reveal everything about your trading psychology. For the next 20 trades, follow your system exactly as written. Don't modify anything based on gut feelings. Don't adjust position sizes based on confidence levels. Don't move stop losses because you think the market will turn around. Just execute your plan mechanically without any creative interpretation. Most traders can't complete this experiment. They'll make modifications by trade 3 or 4 because something feels different about the current market environment. This inability to follow a predetermined plan reveals that they don't actually have a trading problem. They have a behavioral problem disguised as a trading problem. The traders who can complete this experiment usually discover something amazing. Their simple system performs better than they expected because they're finally executing it consistently. They realize they've been sabotaging their own success by constantly trying to improve upon a plan that was already working. This is the cruel irony of trading psychology. The behaviors that feel smart in the moment are usually the ones that destroy long-term profitability. Moving stop losses to avoid losses feels smart, but increases average loss size. Increasing position sizes, when you feel confident, feels smart but violates risk management principles. Adding more analysis to confirm your bias feels smart but creates decision paralysis. Good trading behavior often feels wrong in the moment. Taking a loss according to plan feels like giving up too early. Keeping position sizes consistent feels like you're not maximizing opportunities. Sticking to simple systems feels like you're not using all available information. This is why behavioral discipline is so difficult to develop and maintain. The market is designed to exploit these psychological weaknesses. Every rally makes you want to buy more. Every decline makes you want to sell everything. Every winning streak makes you feel invincible. Every losing streak makes you question everything. These emotional responses are completely natural and completely destructive to trading performance. Professional traders develop what I call emotional neutrality toward individual trades. They don't celebrate wins or mourn losses. because they understand that each trade is just one data point in a larger statistical sample. This emotional detachment allows them to make rational decisions based on probabilities rather than feelings about recent results. Here's what emotional neutrality looks like in practice. You take a loss and immediately start looking for the next setup without any need for revenge or recovery trades. You have a big winner and maintain the same position, sizing, and risk management for the next trade. You experience a losing streak and continue following your system without modifications or doubt. This level of emotional control doesn't happen overnight. It requires thousands of hours of practice and usually some expensive lessons along the way. But once you develop it, trading becomes a completely different game. Instead of fighting your emotions, you're simply executing a proven process with mechanical precision. The beautiful thing about behavioral mastery is that it's completely within your control. You can't control market direction, volatility, or unexpected news events. But you can control your position sizing, your stop-loss placement, and your adherence to predetermined rules. This control over the controllable factors is what separates successful traders from the rest. Most traders focus obsessively on the factors they can't control while ignoring the factors they can control. They spend hours trying to predict market direction while spending minutes thinking about position sizing. They research economic indicators while neglecting their own psychological triggers. This backwards focus guarantees poor results regardless of analytical skill. Good behavior in trading isn't about being perfect. It's about being consistent with your imperfections. Every trader makes mistakes, takes bad trades, and experiences periods of doubt. The difference is how quickly they recognize these mistakes and return to their systematic approach. The most successful traders I know have developed what I call systematic forgiveness. They don't beat themselves up over individual mistakes because they understand that mistakes are inevitable. Instead, they have predetermined protocols for getting back on track after behavioral lapses. When they take a trade outside their system, they don't spiral into self-doubt or abandon their approach entirely. They acknowledge the mistake, review what triggered the deviation, and implement specific safeguards to prevent similar lapses in the future. This systematic approach to handling errors prevents small behavioral mistakes from becoming catastrophic account-destroying binges. Here's something that will completely change how you think about trading success. The difference between a profitable trader and an unprofitable trader isn't their win rate, their average winner size, or their technical analysis skills. It's their maximum drawdown recovery time. Profitable traders bounce back from setbacks quickly because they have behavioral systems that prevent small problems from becoming big problems. When an unprofitable trader hits a losing streak, they typically respond by increasing risk to recover faster, abandoning their system for something that feels more promising, or taking revenge trades to prove the market wrong. These responses turn temporary setbacks into permanent disasters. When a profitable trader hits a losing streak, they typically respond by reviewing their trade execution, ensuring they're following proper position sizing, and sometimes reducing risk temporarily while maintaining their systematic approach. They understand that losing streaks are statistical certainties, not personal failures that require immediate correction. This difference in response patterns creates completely different long-term outcomes. The unprofitable trader experiences wild swings between euphoric winning periods and devastating losing periods. Their equity curve looks like an electrocardiogram during a heart attack. The profitable trader experiences much smaller fluctuations around a steadily rising trend line. Let me tell you about the most important behavioral skill that nobody teaches in trading courses. It's called process trust. This means having complete confidence in your systematic approach, even when recent results suggest it might not be working. Process trust allows you to continue executing your plan during the inevitable periods when markets don't behave according to your expectations. The truth is brutally simple. You can spend the next 5 years mastering every chart pattern ever discovered, or you can spend the next 5 months mastering your own behavior. One path leads to frustration and blown accounts. The other leads to consistent profitability. The choice is yours, but the market has already made its preference clear.